Sorry, can everybody hear me? Someone you just respond in the chat box, please. That I know that you can hear.
I can hear you.
Okay, without further ado, let's start class. Okay, thank you. All right. So good evening once again. Welcome to Teaching Professional. We are looking at chapter 5. And chapter 5 is audit planning and risk assessment. Okay? Hold on. Now, this is the part that please, everybody should make sure you capital of this. Please put your mic. Interfering with the class. So your mic. Capital logistics. Capital, move your mic, please. All right. So I will say we are looking at audit planning and risk assessment. Now, this is where the engagement starts proper. All right. Now, if you want an audit firm, when you want to go for an audit engagement, this is where everything starts. Okay. You're going to have to plan the audit, right? You're able to do a whole lot of things, but at the end of the day, you'll be able to. So, how do we go now? Okay, let's start. Now, audit planning, it commences after the letter of engagement has been put in place. And I told us the letter of engagement is the personal agreement between and the audit firm. The audit firm prepares letter of engagement to the clients sign. So when the client signs, then it becomes a binding document for both parties. So once that has been signed, that means at that engagement that is about to commence, the legal engagement, that is something that has been bound by law to start. So after that letter, the next thing you have to do as an auditor is to draw up your word plan. Now, the audit plan is really to out basically be able to plan your engagement in such a way that eventually, please mute your mic, please. Eventually mute your mic. Thank you. So, like I was saying, it affords you the opportunity to be able to deliver on your plans, on your objective, audit objective to the client. So the audit plan is very, very essential. The purpose of the plan, first of all, let's look at an audit plan set out what needs to be done to achieve an objective. You are writing, you are preparing your examination. It's part of the plan that you have to be careful. That's what you are. And the end of this lecture, let's what it is. So in the exam, the same things are applicable to the audit plan. The audit plan is really the auditor carry out an effective and only that meets the audit objective. But for every engagement, there's an objective that must be met.
Hi, good evening.
Hello.
Good evening, sir. I don't know if it's just me. I think you're breaking.
I don't know. Please confirm. Do you hear me?
Yes, sir, you are breaking actually. The network is fluctuating.
Okay. Okay.
You're actually
What
really
do I
breaking, please.
I think the network is the control. Okay. Network.
So we can't really hear what you're saying. Like the network is really bad.
Is it better like this? Can you hear me like this?
Yes,
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 I
it's
think
much
you're better
better.
now,
Yeah,
sir.
sure.
It's better like this?
Yes.
Yes,
Yes.
yes,
Okay.
sir.
All right. Thank you. So as I was saying, for every engagement, there's always an objective that needs to be achieved. And that is why the audit plan is put in place. Now, when they draw up the audit plan, there are three things that the audit plan needs to contain. And those three things are in form of questions. Who will perform the audit work? When will the work be done? And what work is to be done? Who will perform the audit work means when you embark on an engagement, who are the people that you are going to need? Because one person cannot do it alone. There has to be an engagement team, audit engagement team, that will be constituted for that particular engagement. And there's also another thing they need to also agree on. How long will it take? Because the audit engagement cannot be forever. It has to be time specific. So that you need to know about how long it will take to get the job done, because your client cannot wait in perpetuity. You have to be able to tell them that this is how long your audit will take. And that date, that timing you are giving to them must not change unless there is something critical that can make it change. And you have to communicate timely to them. The third question you need to ask yourself is, at what areas are we going to look at? Because for you to go about any engagement, you must have a scope. What are the areas you need to look at? iPhone, please mute your mic. Okay, what are the areas we need to look at? That is the scope. Because audit engagement is very broad. So you need to be able to look at what are the areas you want to focus on, you would like to focus on. And that's where you are going to channel your energy on. And I also remembered that I've explained to us that there are different types of engagement that you can do. But for most engagements, what they normally do is that they either use a risk-based audit approach or they use audit sampling. Risk-based approach means that it's an approach where the auditor, after carrying out a preliminary audit risk assessment about the client, that is, what are the risks that the client is faced with, right? As a business. That's what's going to help the auditor to design audit plan on how the engagement will go. Okay? So he needs to know what he wants to do. So you focus on those key areas. Similar to also what we have in audit sampling, is where the auditor will focus on certain aspects. We take some samples of some aspect of the business. And at the end of the day, you will now use the sample that he has collected to arrive at a conclusion about the entire business. So the scope is very essential. So in any audit plan that you want to develop, these three questions must be answered. Who will perform the audit? When will the work be done? And what work is to be done? Okay? Now, like I said, before you drop your audit plan, it is essential that you carry out what we call a preliminary audit risk assessment. Now, that audit risk assessment will be the foundation of what you are going to build your audit plan on. Okay? Because you cannot audit what you don't understand. And when you carry the preliminary audit risk assessment, you will be able to understand the entire business, gain understanding of the entire business. Okay? So, and that takes us to the next one, which is the risk assessment and the audit plan. So, for an auditor to carry out an audit engagement, it must be somebody that has done his own background work. He must have done what we call due diligence, to have gone to know much about the client. You cannot be an auditor and you're auditing from the surface. You have to go very deep. You have to be in depth. You have to know so much about the company as though you're a staff of that company. And that is what can afford the auditor this kind of knowledge is when he conducts what we call a preliminary audit risk assessment. Okay, that will enable him to have an understanding of the entity to be audited, the environment in which the entity operates. All right, because you know that every business has its own sector, and every sector operates within certain environments, right? Then it will also afford the auditor to be able to know the amount of audit work performed in general. Okay? The amount of audit work to be performed in general is after he has gained understanding, he will to know, okay, this is how far he needs to go to be able to add value or to give value to the engagement. And the areas on which the auditor will focus his attention, because when you do a preliminary audit assessment, that will highlight those key areas that you need to focus on for that business. Every business has its own peculiar risk. There's no business that has the same risk, that is faced with the same risk. No. The risk that the banking sector is faced with is not the same thing that the IT sector is faced with. It's not the same thing as the agri sector is faced with. It's not the same thing like the manufacturing sector is faced with. There are certain risks that are peculiar to each sector. And the only way the auditor can know about this risk is by carrying out a preliminary audit risk assessment. And that will give him an in-depth knowledge and understanding about the client. Okay? And one thing you need to know again about audit plan is that audit plan is not fixed. Audit plan is iterative. What do I mean by iterative? Iterative is an IT jargon. And what that means is that something that keeps changing. So your audit plan is not fixed. It's not fixed. It keeps changing until when the engagement is completed. I take it again. The audit plan, yes, you develop at the onset of the engagement, but it keeps changing until when the engagement is completed. So don't say that you have an audit plan in the beginning and you must work with it. There are times where what you have set out to do might not be achievable. There will be need for you to make some adjustments. And that's what I mean by what? Your audit plan is what? Is iterative. Okay? That's what you need to know again. So in the exam, they can tell you that somebody can say that the audit plan, he has developed the audit plan at the beginning and is not contemplating on changing it regardless whatever is going to face. That is not supposed to be. The audit plan should be flexible, such that you're able to tweak it or change it, amend it to suit the particular objective you are trying to achieve. Okay? So that is that about risk assessment and audit plan. Does anybody have any question before we proceed? Is there any question? Is there any comment? Is there any observation before we proceed? If there are none, I assume that we are all together, so I can proceed. Also, in audit, there's what we call professional skepticism. In audit, there's what we know as what? Professional skepticism. Now, what do we mean by professional skepticism? What it means is that as an auditor, in plain text, in simple text, it means that you should not always believe completely what your client presents to you. That's what it means in plain text. That you should not take to heart completely what your client presents to you as documents. You should always have some doubt that there might have been some things that they have hidden away from you. And for you to be an auditor that is thorough, to be an auditor that is professional, to be an auditor that is profound, you must have this attitude of what? Professional skepticism. Because if you don't have an attitude of professional skepticism, you become complacent. Whatever your client gives to you, you believe that that is all. And your client, they know when they ask for something, is what you ask for, they give you. And sometimes there are other things that you might need to get better understanding about the engagement. But if you don't ask, they will not give you. So sometimes when they give you some information, you might need to ask them, is that all that is required? You need to tell them, is that all that is required? You need to tell them, you need to ask them, so that they will be able to pour out more. For you to be a good auditor, you must have an attitude of what? Professional skepticism. Okay? So in the professional skepticism, the meaning is to have an attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatement due to error or fraud, and a critical assessment of audit evidence. Adewale, please mute your mic. An attitude that includes a questioning mind. That is, you must have what? A probing mind. That is, Adewale, please mute your mic. Adewale Kehinde, please mute your mic. Thank you. An attitude that includes a questioning mind. What that means that you must have what? A probing mind. If you don't ask questions, you don't get answers. Okay? And being alert to conditions which may indicate possible misstatements due to error or fraud, and a critical assessment of audit evidence. And that's why I said that in plain text is having a questioning mind or having a probing mind and not believing completely whatever your client presents to you as what? As audit evidence. When they give you any information, critique the information so that you can be rest assured that whatever they are giving to you is all that you need. They have not given you half information. That's what we mean by professional skepticism. Okay, and that's why I say that some days that auditors are very difficult to satisfy. Yes, because they always ask, they want to know, they want to be sure that you have given them all that they need. Remember when we were discussing in chapter 1, we talk about reasonable assurance. For the auditor to be able to give a reasonable assurance about the engagement, he must have an attitude of what? Professional skepticism. Now, how does the auditor understand the entity and the environment? Because I talked about when I was talking about carrying out a preliminary auditor's assessment. When the auditor conducts a preliminary auditor's assessment, what that implies is that he must have gained understanding about the entity and its environment. Okay? Now, what are the things that will make the auditor to be familiar with the environment or to have gained understanding about the environment? If you go to ISA 315, that talks about gaining an understanding about the client environment, it spells out there that these are the things that the auditor will need to know about the client. Number one, he must know the industry in which the client operates. You want to audit a Titan Trust Bank now. You must know that that is a bank. Okay? You must know that it belongs to the banking sector. Right? Number two, you must know the nature and competence of its management. How do you get that? You get the brochure or the CV or if there is a page on the website that you can obtain knowledge about the client's profile. You need to know about the client's profile. That will make it possible for you to be able to place some level of assurance on whatever the client is giving to you. Sylvia, please mute your mic. Okay? The entity internal control system, you must be able to understand the internal control system of your client business. If you have two banks that operate, you will agree with me that the two banks will not have the same internal control system. You're going to look at internal control system in chapter 7, okay? But when we talk about internal control system, you're looking at how the entity operates. What are those things, what are those controls they have put in place to ensure that the business runs smoothly, seamlessly, without any interruption or disruption. It's not that when the owner of the business is not around, everything is standstill. We have to wait for the owner of the business to come. If you have a client that until when he's around before everything goes or before everything works, then that means that that business does not have a sound internal control system. If you have a sound internal control system, even when you are not there, your business will run as though you are there. But you talk more about that in chapter 7, looking at the internal control system in chapter 7. Then you must know the current financial performance. How do you get to know financial performance? You look at the company's prepared financial statement. Okay, you look at the financial statement. You look at the management account, right? Other things you need to look at. You need to look at if you have industry benchmark. There are some industry benchmark. We have some ratios that when you have those ratios, they belong to different industries. Is used to measure performance. So when you have a client that don't meet up with those ratios or indices, then you can advise the client that at the rate you are going, if care is not taken, you find yourself in trouble in a few months' time or in a few years' time. Because figures don't lie. Figures don't lie. Okay? Then you also know the reporting requirements and deadline. For instance, you have a client that is into banking operation or that owns a bank. You know that all banks, they must ensure that their audited financial statement is ready for a year, for the current year, must be ready on or before 31st March of the next year, or the following year. When they don't submit their audited financial statement by that time, CBN and other regulators will sanction them. And you should know the one that is applicable to all the sectors, the petroleum sector, the oil and gas sector, the educational sector, the agro-allied sector, all of them. You must be able to know what is their reporting requirements and deadlines. And if there are any recent development, you should be able to also be aware of them. Sometimes your client, most times you have to be ahead of your client. It's very appalling for a client to ask you that, oh, there's a new finance act that has just been released. How does it affect our business as a whole? And you tell the person that, I'll get back to you, sir. That is not professional enough, because you should have been proactive that somebody is going to ask this question. So that means that for every information that is out there, you must always be receptive of new information and share it with your client, so that there should be some information that when you share with your client, they can leverage on those information. Okay? They can leverage on those information. But when you don't know, you cannot advise your client appropriately. So that means for every new development, you must always keep abreast of all information. Okay? Like I said, for you to get an understanding of your client business, you need to understand the ISA 315 that talks about identifying and assessing the risk of material misstatements, understanding the client, understanding the entity and its environment. Okay? Other things you need to also know for you to gain knowledge about your client, because this list I have here is not exhaustive, is by looking at if the company has a journal, a trade journal, or a company journal. CBN, sometimes when I was in school then, they used to produce a journal known as the bullion, where they always analyze all the activities in a quarter or all the activities in a month. It's called the bullion. Or if you want to audit a client that is into real estate, there is this magazine that is called Castle that contains information about most of the things you need to know about real estate. Looking at the environment, the island, the mainland, the pricing of those things, you'll be able to know. These are areas where you can get knowledge. Another area you can get knowledge is by you asking your client to present to you their standard operating procedures. When you see their standard operating procedures, that will guide you properly on how the business operates. Because without the standard operating procedure, no business is operating or optimizing their processes. So you must be able to lay hands on all these documents for you to gain proper understanding of your client business. Because you cannot give what you don't have. Okay? Does anybody have any question before we proceed? Any comment? Any observation? Okay, we proceed. So go to the next one, risk and uncertainty. Now, risk and uncertainty is still part of what we are discussing now. Now, what is risk? Risk is anything that can prevent an entity from achieving their set objective. That is risk. Risk is anything that can prevent an entity or an individual from achieving what? Their set objective. And we talk about uncertainty. Uncertainty is that you are not sure of the possible outcome of an event. Okay? You are not sure about what? The positive outcome, the likely outcome, likely probability or likelihood of any outcome of an event. That is uncertainty. Okay? So as an auditor, you should be able to assess the risk that affect the financial reporting of your clients. You're able to assess the risk that affect the financial reporting of your clients. Because as an auditor, you're able to identify the risk. Then you're able to assess the risk. You're able to review the risk. You're able to put controls in place or mitigants. Then you're able to report on those risks. Remember, in your CSME, under risk management, you have risk management. Okay? When you talk about what's it called? The risk identification, the risk review, the risk reporting, the risk assessment, all of those things. It's the same thing you are doing. Only that in this instance, you are focusing on the business as a whole. You are looking at it from operation point of view. You're looking at it from the business point of view. You're looking at it from the regulatory point of view. You're looking at it from every point of view. So that you don't want a situation whereby your client business is exposed to any risk. Okay? I hope we are all getting me.
Yes, sir.
All right,
Yes,
thank
sir.
you. All right, thank you. So when you talk about the risk, you should be able to know those risks that are internal to the business and the risks that are what? That are external to the business. The risks that are internal to the business are risks that are within the control of the environment, of the entity. Okay? The risks that are within the control of the entity, they are called internal risk. And the risks that are outside the entity are called what? External risk. Those are the ones that the entity do not have or does not have control over. We call them external risk. So the internal risk, the ones that are within the control of the entity, the auditor will be able to advise the client on how to go about it so that the risk does not impact the business negatively. When we talk about risk, two things are very important: the likelihood of occurrence and the impact. When we talk about risk, internal risk or external risk, two things you need to consider: the likelihood of occurrence and the what? And the impact. or you can put it in this way, the probability of its occurrence and the impact. Once you're able to identify these two, the risk can be better managed. Okay, the risk and what can be better managed. So if in drawing up the audit plan, it is important that the auditor should be able to what? Assess the risk, carry out a risk assessment. And the risk assessment is just like the audit plan also. It keeps changing from the time when you started planning till when the audit engagement is completed. You must keep on evaluating the risk. You must keep on assessing the risk. Otherwise, if you lose focus of those risks, it could later on have a negative impact on the business as a whole. And that's the essence why you need to keep what? Keep assessing and evaluating the risk. For instance, let me give an instance. We are talking about this protest that is on now. Let's say the auditor is already in the office and is looking at the financials of the company. You should be able to assess and tell the company, especially if it's a manufacturing concern, that this protest that is on now, if there's a way you can stagger your operation. For instance, most manufacturing concern, they work 24 hours. So because of the nature of the protest, you can say that, okay, people that work in the morning section, there should be light work in the morning. While people that comes in the afternoon and evening, that works in the afternoon and evening can come around and do their work. Because you know that if you don't produce in one day, you are going to lose revenue, you are going to lose money. Because there are some costs that are fixed. Diesel is fixed. Electricity is fixed. Salary is fixed. What I mean by fixed is that you pay them whether you like it or not. And if you know you are going to pay this cost, why not optimize the value of this cost so that at the end of the day when you are paying it, it will not be pinching you to pay. You know that, oh yes, I've utilized everything optimally. Okay? So they're able to advise them. And for those that are working at the back office, if they can't come to work because of this protest, they're able to work remotely. At least we have tried that during the COVID era. So all of these are what need to be put in place. These are internal issues. Yes, Oluwaseun, do you have a question?
Yes, I do.
Please go ahead.
Yeah, I've heard you say, auditor, that we advise. I want
Yes.
to understand, do we advise or we give opinions? Because I was thinking it's consulting that we might be advising. So I want to get
You said what?
your view about this. I've been hearing you say advice, the auditor should
Yes.
advise their clients.
Yes.
So
Yes.
I want to confirm, do they advise their clients or their responsibility is to give an opinion?
They give an opinion on the financial statement. But in this critical time that there is protest and there is something like a partial lockdown, the client can approach the auditor and say that, please, what can we do in this time? The auditor will not say that my own is just to give opinion. No. There are instances where you need to render advice. It's advice. It's like a recommendation. It's either they take it or they don't take it. You are not imposing it on them. All you are trying to do is to ensure that they have fully maximize or optimize their processes and production. That's what you're after. Yes, the audit opinion will come in when he's preparing his audit report. But there are instances where the client will always seek advice from them in these instances, like what we're experiencing now. They can seek advice. That's what I mean. That does not rule out the fact that because you are the external auditor, your work is only on the financial statement. No. Okay, I hope that I've been able to answer your question, Mr. Oluwaseun.
Yes, sir. Thank you.
All right. Any other question? Any other question? Okay, let's continue. Now, as the auditor, when you are drawing up your audit plan, you have to also bear in mind how you are going to go about the engagement. And that talks about what? The audit strategy. What strategy are you going to use to be able to what? Achieve your audit objective? There are about 4 different strategies that the auditor can use. All right? What I'm discussing is here. And here, these are the strategies. They call it audit approach. There's what we call the substantive testing audit approach. When you are using substantive testing audit approach, this is it here, right? The auditor will ensure that everything that has to do with documentation, he has to examine everything. So what that implies is that you only make use of substantive testing audit approach when you have businesses that are small, when you have businesses that are new. For businesses that have stabilized, that are big, you might not be able to utilize substantive testing audit approach. Imagine you want to carry out audit of a bank, let's say UBA, for instance, and you now decide to use the strategy of what substantive test. What that implies is that you are going to check every transaction in all the branches of UBA. Is that realistic? The answer is no. But for businesses that are just starting, for businesses that are small, medium scale enterprises, you can deploy substantive testing audit approach. All right. Then you have another one. It's called what? The system-based audit approach. Now you make use of system-based audit approach when you have a structure. You have put down a structure. There is a functioning corporate governance. There is a functioning and effective internal control system. When you have a sound internal control system, you can utilize system-based approach. Now, system-based approach essentially rests on what, or depends on what? The client's internal control system. So that means that if you have an effective internal control system, obtaining information or obtaining audit evidence will not be something that is challenging. You'll be able to get information just at the click of your finger. When you talk about internal control system, when you talk about internal control system, you're looking at what? Having a robust accounting system that you go to the ERP, whatever information you need, you can spool it from the ERP. You can spool it on the ERP. Or sometimes you have already designed you have already installed your audit software on the ERP. And your audit software has been programmed in such a way that is giving you report timely on the ERP. And that will help the auditor to be able to carry out an effective auditing. Okay? So for you to use a system-based audit approach, you must have a sound internal control system. And when you have a sound internal control system, obtaining audit evidence will not be something that you are struggling with. It will be very easy and very cheap for you to do. Because the system is already automated, the controls are already in place. You know who to meet for any information that you require. And this information are delivered to you timely, online real time. There are other approaches that you can also use. We have another one that is also possible. Is called the business risk and risk-based approach. And that one is mostly used by clients or entity that are already developed, that have already developed their internal control system. mostly large multinational corporation like Mobil, like Total Energies, like Schlumberger, all those ones, all those big companies, they can utilize what we call business risk or risk-based approach, right? Then you have another one that is called statement of financial position audit approach. That one is just an advanced level of the substantive testing audit approach, because that means that you have improved on your substantive testing, you have put system in place. Then you can now utilize the financial statement that you have, that is the same financial position, as a medium or as a yardstick for you to what? To evaluate the performance of the client's business. All of these approaches, you can utilize them. I hope we are all together. Ugona, do you have a question?
No, sir.
Please mute your mic, please. Thank you. Any comments before we continue? Any comments? Any observation? All right,
Sorry,
we
sir. So
continue.
please,
Yes,
if I got you
please.
correctly, all
Yes,
of all these strategies are strategies used for auditing, you mean?
yes, you can utilize
Okay.
any of them, any,
Okay.
depending on the nature of your client business. For you to utilize any of them, you must have gained proper understanding of your client business.
Of the client's business. Okay.
Yes. All right.
All right. Thank you.
Oluwaseun, I'm with you. You're welcome. Oluwaseun, please talk.
Yeah, I just I want to know why multinationals are using risk-based audit approach.
You said what?
I said I would like to know why multinationals, why they are using risk-based audit approach.
Now, risk-based audit approach, like I said, is for businesses or entities that are very big, right? So for multinationals, they are not concerned about what is happening now. They are more concerned as to what is going to happen in years to come. Most businesses that are small, medium scale businesses, they're only concerned as to what they are doing now. They are not looking into the future. When you employ a business risk or risk-based audit approach, what that implies is that you are trying to look into the future. That means you'll be making use of what we call there's a term we call it. If I'll get it. Don't worry, I'll get it. It just keep my memory. As I wanted to mention it, I just keep my memory. It's going to make use of what we call um assumptions, and what do you call this thing? Estimates. You make use of what? Assumptions and what? Estimates. Because you want to predict what will happen in the future. Multinationals now, most of them, they are already thinking 10 years ahead of their time, right? Like the oil and gas now, the likes of Mobi, Total Energies, they're already far ahead because they know that some of their clients in terms of countries, some of them will run out of supply of the crude oil in years to come. So they're already planning their exit. What are the things they need to do? They will not wait until when the oil wells are dried up before they say, okay, let us move. They won't. And that is why they're always looking forward. They're always forward looking to other things that they can do. What are the things they can quickly enhance from their clients' countries? So that's one of the things that one of the reasons why they deploy the what we call the business risk and risk-based audit approach, because they're always forward looking. I hope I'm able to answer your question, Mr. Oluwaseun.
Yes, sir. Thank you, sir.
All right, thank you. All right. So we proceed. We go to the next one.
Excuse
That
me,
is
sir.
called, yes, Augusta, I'm with you.
Okay, according to what you just said now, how many
Yes,
types of risk approach do we have? Because what I can see here is just the substantive approach and the system approach. But you made mention
there,
of risk-based audit
there are
approach.
four. There are four.
What was the fourth one, sir?
Statement of financial position audit approach.
Have you talked about that, sir?
I did. I said that is an advanced form of what? Substantive testing audit approach. I did
So you
mention
said
it.
statement, sorry, maybe I joined late. Statement of
Statement,
approach,
statement of financial position audit approach.
audit approach. Okay, sorry, what did you say it is?
I said is an advanced form of substantive testing audit approach, where I said
Okay,
that in substantive testing audit approach, there is no system. Everything is what manual because the business is just starting or the business is still very small. But in a system of financial position audit approach, I said that there is already a system. There is already a system, but the system is still developing. So the system, from system, you can prepare your statement of financial position, which you can use to evaluate whether the company is performing or not. In the case of
okay,
society testing audit approach, you don't have a system, or the system is still very weak. That's why the auditor will look at everything. You talk about substantive testing audit approach, that means that the auditor will evaluate everything. He will check everything. He's not going to use sampling. He's going to check everything in substantive testing audit approach because the system is not in place or the system is weak. But in the case of system of financial position audit approach, there is already a system that is already developing. And that is why they can prepare the statement of financial audit, the statement of financial position audit, statement of financial position, where the auditor can use to evaluate if the business is performing or not performing.
okay. I'm sorry, sir. According to
Yes,
your arrangements, the first one is the
yes,
substantive approach, which is
yes,
for small business that is still growing. Then
yes.
after that, we have the statement of financial audit approach, where the
Statement of
system is
financial, hold on. Statement of financial position audit approach.
okay.
Statement of financial position audit approach.
Okay, so this one is developing, is bigger than the substantive approach. Then
Yes,
after that,
yes.
you made mention of the system approach, where there
System-based
is
audit approach.
already a system in place
Yes, yes,
for maybe bigger business
yes,
companies. Then after
yes,
this one, the last one you made mention is the risk-based audit approach for very large companies.
yes.
Okay, all right. Thank you, sir.
All right. I hope it's clear.
Yes, sir.
Okay. Any other question? Are we all together? Okay. Let's go to the next one. We are looking at materiality. Now, materiality is one area that is also very important during the audit planning. The audit the at the planning at the plan during the planning phase, they have to also determine what the materiality is. Now, what is materiality? Materiality is covered under ISA 320. And what it means is that materiality means information is material if its omission or misstatement would influence the economic decision of users taken on the basis of the financial statement. Information is material if its omission or misstatement could influence the economic decision of users taken on the basis of the financial statement. What does that mean? What that means is that when that information is missing or the information is misstated, it has a way it affects the economic decisions of the users of financial statement. That's what I mean by materiality. That is, when an information is missing or the omission has been misstated, it has a way of affecting the economic decisions of the users of the financial statement. Take, for instance, the financial statement that has been prepared, they have omitted or they've misstated the profit. Maybe the company ran at a loss in that year under review, but the auditor mistakenly said that the company made profit, where in fact they made loss or they made a loss. Now, the stakeholders, they are already planning on how to invest more in that business. Or some of them are already thinking of how they can demand for their what? For their dividend. That's the return on their capital. Whereas the company made a loss. So that is what we mean by materiality. So the omission or misstatement of an information affecting the economic decision of the users of the financial statement is what we know as what? Materiality. And that is why, one of the reasons why you talk about materiality is that when the auditor is drawing up his audit plan, it determines the materiality threshold. It determines what? The materiality threshold. That is, to what extent, because one thing the auditor wants to achieve is this. Yes, I might not be able to review, I might not be able to examine all the aspects of the business, but to a very large extent, the areas that I've covered, you should be able to have what? A reasonable level of assurance to take decision on that area or on the business as a whole. That's what we mean by materiality. That is, yes, the auditor will say that, yes, I cannot guarantee that I've looked at everything. But to a large extent, let's say to about 90% or 95%, I'll be able to cover every aspect of the business. And you can rely on the audit reports that are presented about the business. That's what we mean by materiality. Materiality is trying to cater for a way of reducing the risk of material misstatements in the financial statement. The risk of what? Material misstatements in the financial statement. The financial statement contains misstatements, no doubt. There is no financial, I said that in chapter 1, but there is no financial statement that is free of misstatement. I said it in chapter 1. But financial statement must be free of what? Material misstatement. Material misstatement means that something that can affect the economic decisions of the users of the financial statement. Such information should not be misleading. Such information should not be omitted. So the essence of the materiality is to ensure that the risk of material misstatement is on the what? Is on the lowest. Okay? That's what we mean by materiality. And like I said, when the auditor is drawing up his audit plan, other things he also consider or put into consideration is the risk assessment, as well as what? The materiality threshold. Okay? Now, for the auditor to be able to determine what the materiality threshold is, number one, he must have gained understanding, reasonable understanding or knowledge of the business. Okay? That's number one. Number two, the auditor should be able to understand that the financial statements are prepared and audited to, to, to the levels of what? Materiality. Okay? Number three, the auditor should recognize the uncertainties inherent in certain amounts in the financial statement, e.g. provisions. Let me explain that. Now, remember I said that the financial statement should be free of what? Material misstatement. Right? Now, we'll still look at it. I'm still going to explain that in audit risk, right? We are still going to audit. Let me just use this time to explain this point. That is, recognize the uncertainty inherent in certain amounts in the financial statement, such as provisions. Let me explain what that means. Now, what it means is this. When you talk about provisions, okay, it means that you are trying to provide for a cost that is yet to be what? Determined. Okay? That's what we mean by provision. You are providing for it. You don't know the actual cost, but you know that this cost will come. It's certain, but you don't know the actual amount. So you are going to provide for it. So that at the end of the day, you are going to under provide or you are going to over provide, which you are going to now adjust for later on. What you are going to provide for it. For instance, electricity. Electricity, you cannot say categorically that this is how much you are going to pay in a month because it depends on what? The wattage, how much electricity you have within a month. So let's say you have provided for, let's say, 1 million. By the end of the month, when they calculated and brought your bill, which is prepaid, they gave you 900,000 or they gave you 1.2 million. That is what? That is provision. You are going to adjust for them, either of them accordingly. Okay? That's what we mean by that. So that is what materiality, one of the things that you need to understand, because for you to carry out, to determine the materiality threshold, you must have this understanding that there are certain transactions that you cannot, that are susceptible to what? To manipulation. Okay? They can change because of their nature. All right? Yes, Oluwaseun, please continue.
Okay, please, based on this example you just gave, right, concerning
Yes,
provision, you said
yes,
electricity. So I'm like,
yes.
when you're auditing for the power, like you're auditing after
After the
the
fact.
yes. So why? I think
Mm.
it's not the provision again. You'd have, I use electricity, you'd have known how much you actually spend on
Yes.
electricity. So why you still, yeah, thanks.
But okay, you know what? When you talk about what the example I gave now, yes, the auditor is looking at historical cost. But for the multinational, they are looking at, like I said, they are looking at what? Into the future. So they will look at, okay, if by now we are paying this much this year that's under review, how much are we going to pay next year? So what are those things we can put in place to further reduce our what? Electricity bill? For instance, they might decide to start talking about what? Investing on what? Inverter or other alternative source of power. You know what I'm saying? They can decide to invest on what? Gas turbine. So for multinationals, these are the reasons why they are making use of what? Risk-based audit approach. Do you understand? I hope I'm able to clarify that, Mr. Oluwaseun.
Yes, sir. Thank you, sir.
All right. So that's that. Then the next one, still under materiality, make reasonable economy decision based on the information in the financial statement. Now, you know that in financial statement, there are times when the management that prepare the financial statement, they make some estimates because they could not get actual value. So they are going to use estimates, estimated figures or values. Now, when the auditor is trying to utilize or determine his materiality threshold, the auditor to be able to ask these people, how reasonable or how realistic are these your estimates? For instance, you had a sales for 11 months. The 12 months you don't know. Maybe because the figure did not come in before the preparation of the financial statement. But you need to put a figure there. You have 11 months. You can project what your 12 months will be. So what we are saying here is that you are projecting. You must ensure that you are very realistic, not that you are over ambitious. For instance, if the average of the 11 months for a year you have made 120 million, why are you putting your 12 months that you are going to make 400 million? That for the 12 months you are going to make 400 million. That means you are over ambitious. If you put it as something in the range of, let's say, 150 or 200, yes, it's still reasonable. And okay, maybe December, because of all the flexibility, is my rise, depending on the sector where you operate from or where you belong. That's what we mean by it. All of these are the factors that the auditor considers when he wants to determine the materiality threshold. Okay? So ISA 320, which is about materiality, expect that the auditor should apply the concept of materiality when planning and performing the audit. I've talked about that. Okay? When evaluating the effect of the statement on the financial statement, I've talked about that as well. That's what the auditor will need to watch, to consider. Okay? And I also said that at the planning stage, risk and materiality are the two key factors which determine the auditor's answer to what audit work is to be done. I've talked about that. And when you're doing your audit plan, you'll be able to determine what will be your what. What is your risk assessment and what is your what? Your materiality threshold. All right? I hope you understand what I'm saying. Okay, now let me further explain on materiality. But this area is very, very winding and it's very, very tricky. So you need to pay attention. You need to be attentive. If you don't get it, please, you can always ask me to recap. I'll recap as much as possible till you understand. Okay? Now, what you need to know about materiality is this. When the auditor is setting up his audit plan, like I said, it determines his what materiality threshold. What that implies is that he has some basis. Most audit firms, they have their basis that they use when they go for any engagement. Now, on getting to the field, they can now discover that the basis that they have used might not accommodate what they found while on the field. Let me give an instance. So when the auditor is going, based on their checklist, they have provided the maturity threshold to say that, okay, for revenue, because for you to determine your materiality, you can use uh, any of these indicators. Number one, you can use your net revenue. You can use your profit before interest and taxes. You can use your net assets. Okay, you can use your net revenue, profit before interest and taxes. You can use your net assets. Okay, so these are some of the things you can use to determine your maturity threshold. You cannot use the three at a go. You can use any of them. For instance, if you are using net revenue now, you need to look at how much has the company done in a year under review. So you determine what your revenue threshold, what your maturity threshold will be if you are using what revenue. And if it's revenue, it might be that anything from between 3% to 7% is a rule of thumb. Rule of thumb means that it is not fixed. It depends on what has been used over time and has now become what? Adoptable or becomes acceptable. So audit firm, they have their rule of thumb, which they use to determine or calculate their maturity threshold. So that maturity threshold that they determine, in case they are using net revenue, they might use it as what? Between 3 to 7%. What that implies is this. If there's any issue in the engagement, if does not fall, if it's like if we calculate the materiality to be 3%, let's say 3% of 150 million now. 3% of 150 million could be maybe 200,000. Okay? 3% of 150 million could be what? 300,000. Now, 300,000 to 150 million is very, very immaterial. So the auditor will not look at transactions that are below 300,000. That is what it means. Okay? And if it's 7%, you need to also calculate that. Okay? That's 7% of 150 million. So you still see that it's still not too far. Okay? 7% of 150 million. If I use my calculator, it will be, but I need to be practical with it so that we all can get it. Okay? 7% times 150 million. That is uh 10 million, 10.5 million, 10.5 million. Okay. Now, compared to 150 million, it's still not very, very material to some organizations. Okay. So when you talk about materiality level, it is not fixed such that, okay, if they are using this for this company, they are going to use this, they are going to determine the threshold based on the size of the company. So the company is small. Obviously, the maturity threshold will also be small. And the company is big. Maturity threshold will also be big. Okay? I hope you understand. So that you don't say, what am I saying? So that's what you mean. For instance, now, somebody, if some people loses, let's say 500,000 naira, 500 naira now in a day, it can make the whole week to be miserable for them. And somebody will lose 1,000 naira in a day, and it will not even feel it at all. He will not even know that he has lost anything. Why? Because 1,000 naira is immaterial to what he gets on a daily basis. But somebody, maybe 500 naira is what he gets for a whole month, for a whole week, and he now loses it in one day. Definitely is going to be miserable for the rest of the week. So that's why I said that materiality is what? Is relative. It's subjective to the nature or the kind of business that you do. What is the size of your business? That's what they use to calculate the what? The materiality threshold. I hope I'm making sense. So now the auditor has gone has determined from his office because he has done his own background check. He has done what we call irregularities assessment. He knows what the revenue is. He knows what their total asset is. He has done it. He says, okay, it's 3%. That is 300,000. Okay? Is it 300,000 or 3 million? Let me be sure so that I will not be giving the wrong information. 3% times 150 million. Okay, that's even 4.5 million. Sorry, 4.5 million. So you can see. So the auditor will now say that anything that is below 4.5 million, because he has asked the client also, they say, okay, it's immaterial. So anything that is below 4.5 million, the auditor will not focus much attention on them. And the one that is like 7%, that is like 10.5 million, the auditor will still not focus. So anything within that range, the auditor will not focus attention on them. Okay, now that does not mean that it does not have what we call aggregating all the information. For instance, if it gets like 300,000 in 10 places now, or get 300,000 in 15 places, that is like 4.5 million. You understand? So if he aggregates those amounts, because he knows that the preparer of the financial statement, they are also very smart. They will not just put a big figure there. They are going to break it down into granular, into small amount. That will make it difficult for the auditor to what? To detect if they have perpetrated any fraud. It takes an auditor that is very, very skilled, or an auditor that has this professional skills, that are able to determine that, oh, these people, they have perpetrated fraud, because you see that the figure that you are looking, you're not going to see that figure in lump sum. You're going to see that figure in small amount. By the time you now add it up, looking at the narration of those transactions, you see that they are similar. Then you can now present a case and say, oh, this is like a fraud that you have just uncovered. Do you understand what I'm saying? So that is why you see that sometimes when the auditor comes, they tell the auditor, this 50,000, you do not see that they have stolen 50,000, because to the company, 50,000 naira is more money. The company that is making over 150 million naira in a month. Hope you are getting what I'm saying. So that is what they now do. So when they now get to the field, because they will have told them from the office that, okay, this is the range you are going to look out for. So when it gets to the field, it gets to the client premises, you now discover that what the target that they have set, the threshold that they have set is very low or is very high. Either of the two can play out. Either it is very low, either it is too low, or it is too high. So what that means is that, because they have already told the auditor that when you use this range, you have to obtain like X amount of samples. You have to collect X amount of sample to prove that this financial statement does not contain any material mistake. That is when you are setting out the materiality. I say that the reason for materiality level, materiality threshold is to be able to reduce to the barest minimum the risk of what? Material misstatement. How do you prove that? You must obtain certain number of what? Samples to prove that there are no material misstatements contained in the financial statement. Okay, so you now see the situation whereby the auditor will now say, okay, you have set out like 3 to 7%. You now get to the field, let's go at that. They say that for 3 to 7%, you should be able to obtain like what 20 samples of those transactions to prove that there are no material missing in financial statement. You now check, you did your sample by looking at the account schedules, the revenue schedule, all the schedules, you check everything. You could not even get up to 5 because the threshold you have set right from the onset is too high or it is too low. So what that implies is that when you now get to the field, there might be need for you to do what, to do some adjustments. So when you reduce or you make adjustment to the initial materiality threshold, you now have what we call what? Performance materiality. You now have what we call what? Performance materiality. The first one you have is what? Materiality threshold. Okay, or you call it the overall materiality. So you get to the field of play, you discover that what you thought you had was not practicable, was not achievable. You are going to come to your reality or realization, and you need to what? Adjust the what? The materiality threshold. So when you adjust the materiality threshold, what you now have at that time is what we call what? Performance materiality, because you got that while on the field where you are performing your audit engagement. Okay? That's what we mean by performance materiality. I hope that is clear. Does anybody need to explain that again? Are we together? Any question? Is that explanation clear to everyone? Someone should just say, someone should chat me up on the chat box, please.
Sorry, can hear you, sir.
Please, sir, can you come again, please?
Come again with what? Come again with what? If I react. Which one? Which one did you not understand? Which one? Please talk now. There's no time. Time is running out, so please. What do you want me to come again? What do you want to explain? Is it everything again or which one? Let me know.
Maybe the illustration you just gave us now, sir.
The illustration I gave you. Okay. Let me explain for the last time because we have a lot to go. We are still on page 4. We are going to page 9. Let me further explain. Now, I said that as a client or as an audit firm, when you are going for your engagement, you determine your overall materiality at the planning stage. Now, when you now get to the field of, when you get to the field, when you get to your client office or premises, you now discover that what you had planned initially cannot work. So that means that you might need to do what? Do some adjustments. Now, when you do some adjustments to be able to achieve the audit objective that talks about what materiality, then you're talking about what? Performance materiality. And that was why I used that example. Now, these are some of the indicators of what you can use to calculate your what? Your materiality. You can use your what? Your profit before income and taxes. You can use your net revenue. You can use your total assets. Okay? You can use your total assets. You can use which one again? Equity. You can use your equity. Okay? Any of which you can use. You can use your net revenue, like I said. You can use your profit before interest and taxes. You can use your total assets. Okay, you can use your equity. Any of them. What I'm saying is this. Let's say you cannot use the 4 of them. You need to use just one of them. You cannot combine. You either use one of them. Let's say you are using revenue. So you have gotten hold of the management account of your client and you saw that the revenue they have made for the year or on the average monthly is what? Is 150 million naira. 150 million naira. Okay. Now, You now want to use revenue. If you are using revenue, the rule of thumb is what? Between what? 3 to 7%. This is it here. I mean, 1 to 3%. This is it here. And you see, 1 to 3% revenue. 1 to 3%. Okay. Now, what does this mean? Now, for companies that are publicly listed, big companies that are listed, they're always conservative about reporting their revenue. They don't want to expose their revenue because of tax exposures. Okay, they always want to under report their revenue. Okay, so they always want to play within this 1%. Okay, but for companies that are private, those ones they want to show that they have money, whereas they are not that big, but they want to show that, oh, we have arrived. So they will take for this one, they will go for the higher one, the 3%. But for small companies, I mean for big companies, they go for what? The 1%. That's why you have the 1 to 3%. 1% is for big companies because they're always conservative about reporting their revenue. Why the small companies, they don't want to see themselves as small. They don't want people to regard them as very small. They always want to flaunt, they want to showcase their revenue that they are there or they have arrived. Hope you are getting that. So if you take 1%, I'm using calculator so that we cannot be on the same page. You take 1%, 1% of 150 million. 1% of 150 million is what? 1.5 million. What that implies is that for that big organization that is listed, so any amount, if the auditor is checking and he sees anything below 1.5 million, the auditor does not need to pull further because it's what the company can forego, they can overlook. It does not affect the company in any way. You understand? Now, but for the small company, right, theirs is what? 3%. So what that means is that if theirs is 3%, that means that they say that what they say they have arrived. So anything that is below 4.5 million, because 3% is 4.5 million, anything that is below 4.5 million, to them also, they are not bothered. You can see the contracts, the contracts in what I'm trying to say. Good. Now, this is where the explanation now comes. Now, that does not mean that they are looking now. What that means is that they are looking out for transactions, maybe one that is 1.5 million or one that is just 1.5 million. But the auditor will not overlook instances where he sees related transactions that when you sum it up, they will amount to that amount that we are talking about. Because something that wants to perpetrate fraud now is going to make it difficult for the auditor to unravel or to detect the fraud. So it's going to do everything possible, humanly possible, to make that possible. So it's going to do everything. So you can now break that for 1.5 million into like 20, 30, like that, stagger the money in that way. That the auditor that is not skillful might not be able to detect that fraud, except for the one that are skillful. So at the end of that, if you aggregate all those money, you now sum up to that money, then that one is different. But what I'm talking about is this: you have said out that, oh, you are looking out for 1.5 million. Anything below 1.5 million, they have told you that if you set out your maturity to be 1.5 million, the samples you need to collect from the account schedule, especially revenue schedule, should be to the tune of like, let's say like 20 or 15 of those transactions that will give you that will prove to you that there is no risk of what material, that there is no risk of material misstatement. But you're only able to obtain like 5 as against 15. That means you are not doing well. That is, the audit objective cannot be achieved. Okay, so what will the auditor do? The auditor is now on the field. He now discovered that this is not possible, it's not realistic. So he needs to do what? Because what he saw on the field means that he needs to reduce the materiality threshold that he has initially set so that he'll be able to obtain more. That means that rather for him to use 1% for big companies, it might take it to maybe 0.01% or 0.1%. 0.1% is not the same as 1%. Okay, so you change it to 0.1%. Possibly, you might get as much samples as possible, unlike the initial one that you have set before setting out on the engagement. So when he decides to adjust the overall materiality that he set initially, then that is what we call what? Performance materiality. I hope it's clear now. This is it here. Performance materiality recognizes the fact that if all the areas of the audit are carried out to detect all errors or omissions under the overall materiality level, that objective will be achieved. But when all the individual immaterial omission or error are added together, overall materiality could in fact be breached. Performance materiality is a way of taking the risk into account and will be set at a lower figure than the overall materiality. This may be one or more performance, or there may be one or more performance materiality level, as the levels could vary by area. I hope you understand. So this big grammar that you have there is what I've been taking time to explain. So that by the time you are reading it again, I believe that it will be it is clearer, or it will be clearer when you are reading it again. I hope everybody is clear now. Are we all together? Yes, Uduwachu.
So,
I'm
so
with you.
sir,
Go ahead.
yeah. So when we get this performance materiality, what do we now
Yes.
do to the overall materiality? Do we forget about it?
Yes.
And
No, you are not for. Okay, let me allow you finish. Yes.
yeah, that is
And
first
what?
question. And so secondly, please, where does SUM, where does it fall?
F
SUM,
SUM.
yeah.
What is SUM?
I think there's also like, I think there's also, okay, SUM, what I know about SUM, like if you're, like, it's also a form of materiality that
Explain
is
it now. Explain yourself.
it's for individual, like I will just cite an example, like,
Mm-hmm.
let's say we are trying to do a financial audit and we have different GL codes based on assets, liability, and
Mm-hmm.
all of that. So SCM is like what we use for, I don't know if it's an underset of performance materiality that is for
Okay.
each line, like each FSLI now. Yeah, I think so. Like for each like asset now, this is the. So I want to know if there's something like that
It's
here.
called that one
That's what I'm asking.
that one is under performance materiality. What you just explained now is under performance materiality. Now you now ask that the first question is that what relevance is that overall materiality when you now have a performance materiality? Now, valid question. Now, what you are going to do now is that in the course of your audit, you are trying to explain, you're trying to arrive at your opinion. You will set it clearly that you initially set your overall materiality, right? But in the course of the engagement, there is a need for you to what? To adjust your performance, I mean, to adjust your what? Your overall materiality. And that is what gives rise to what? Your performance materiality, which in a sense has made it possible for you to conclude that there are no risk of material misstatement in the financial statement. You're going to make mention of both of them. You're going to make reference to the overall materiality that you have set and the reason why there was what? There was a need for you to adjust the raw materiality to accommodate what you found while on the field. Who are going to answer your question? Are we all together? Any
Yes,
other
please.
question?
Yeah.
Mm.
Yes, please. And can you also help me talk more about the SCM so that I can understand better? Thanks.
See, see, like I said, is a type of performance materiality as well. Okay, now it's similar to what I've just explained. It's just that that one is peculiar to some kind of audit. It's not for every audit. It's not for every engagement. Okay. So that we will not. I don't want
Okay,
us
thank
to.
you.
I don't want us to lose track of what we are explaining because the time is fast spent, right? We have less than an hour to go, and we are not done. And I want us to finish this as much as possible. And I don't want to rush it. At the same time, I want us to all be on the same page. I hope we are all clear on this performance materiality and overall materiality now. So when you are reading it again, if you have any issue, you can get back to me. But I believe now that it's clearer. Can we proceed? Somebody should just say yes on the chat box so that we can move ahead.
Yes, sir, we should proceed. We should proceed.
Thank you. Thank you very much. So we go to the next one, the audit risk model. Let's talk about the audit risk first of all. What do you mean by audit risk? Audit risk is the risk that the auditor will give an inappropriate audit opinion. Audit risk is the risk that the auditor will give what? An inappropriate what? Audit opinion. That is what we mean by audit risk. That is, there's every chance that out of 100, there's every chance the auditor will give 5% or 10% wrong audit opinion. That's what we mean by audit risk. Okay? Now, what are those things that constitute audit risk? Now, audit risk has three main components. The three main components of audit risk are inherent risk, control risk, and detection risk. Audit risk has what? Three components, and they are here. Inherent risk, control risk, and what? Detection risk. Okay? Now let's look at those risks one after the other and how they affect the overall and the total audit risk. Now, what is inherent risk? Inherent risk is the susceptibility of an assertion about a class of transaction, account balance, or disclosure to a misstatement that could be material either individually or when aggregated with other misstatements before considerations of any related controls. That is big grammar, right? You might not be able to put it down like this in exam, but this is what you need to know. This is how you paraphrase it. Inherent risk is the risk that about a class of transaction or account balances or disclosures that are susceptible to what? Manipulation. A class of transaction, account balances, by their nature, they are what? They are susceptible to what? Manipulation. That's what we mean by inherent risk. When something is inherent, that means it is inborn in a way. That is their nature. So that's why I said that the auditor needs to ensure that the audit risk is always brought to the lowest level, right? Acceptable level. So what do I mean by inherent risk? Now let me explain. Now, if you look at your financial statement, let's take a look at our state of financial position. Let's look at our uh, non-current assets. Now, non-current assets, in a way, you can say that it's okay, but you agree with me that when you don't test your non-current asset for impairment, the carrying amount that you have put in your financial statement as the value could either have been understated or overstated. And if that has been, that is by the nature of a non-current asset, they are susceptible to what? Manipulation. Because they don't test for impairment on the asset, then that means that the value that has been provided is what? Is misstated. Another one, current assets. Let's look at our inventory. Inventory is covered under ISA 2, right? That's inventory. What does the rule says? What's the disclosure for treatment of or recognizing inventory? It says that inventory, the costing method for inventory is to use what? Either to use what? First in, first out, or weighted average. Now, if in the course of valuing your inventory, instead of you to use first in, first out, or weighted average, you went and used last in, first out, or base stock, or standard costing. If you have used any of these one that I mentioned now, outside the first in, first out, or weighted average, what has happened is that you have understated or you have misstated the value of your inventory. Why? Because by their nature, they are susceptible to what? Manipulation. That's what we mean by account balances. Okay? Another example is bank. If the auditor does not confirm from the banks themselves by obtaining a certified bank statement from the bank on behalf of the client, the bank organization that is going to review or that he has reviewed might have been prepared using a falsified bank statement. You know, bank statement can be falsified. Okay, but if the auditor requests for the bank statement directly on behalf of the client from the bank, the one that is presented to him is going to check with the one that they have prepared the bank concession statement to be sure that the values they have there, they are what? They are similar or they are the same. That's inherent risk. Control risk. He said that this is a risk that a misstatement that could occur in an assertion about a class of transaction, account balance, or disclosure, and that could be material, either individually or when aggregated with another misstatement, will not be prevented or detected and corrected on a timely basis by the entity's internal control system. That's a big grammar, right? To paraphrase it, this is what you are going to say. We talk about control risk. This is the risk that the internal control system will fail to what? To detect. Simple and short, to have paraphrased it. This is the risk that the client internal control system will fail to what? To detect. So for instance, the client have put out a policy in their procurement policy that any transaction, any procurement above 1 million naira, they should attach an LPO, local purchase order. So when the auditor checks, when he's doing his own audit, looking at procurement purchases, he saw that out of 100 procurement above 1 million naira, none of them had the LPO attached to them. So that means that the control that they have put in place is not effective. It's not detecting anything. That's what we mean by what? Control. That is the internal control system that they have put in place has failed to achieve his what? His objective. That's control risk. The last one, detection risk. Detection risk is the risk that is peculiar to the auditor. And let's read what we have before I paraphrase it. Detection risk is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists and that could be material either individually or when aggregated with other misstatements. Paraphrase. This is the risk that the audit procedure performed by the auditor will fail to achieve the audit objective. This is the risk that the audit procedure test performed by the auditor will fail to achieve the what? Audit objective. Due to what? Maybe it does not have proper understanding of the client business. Okay. Or number two, it does not, the procedure he has used or the tools or the testing that he has used is not correct. He didn't use the correct parameters, he didn't use the correct samples. That's where he's going to have this detection risk. That's what we mean by detection risk. So I've explained inherent risk, I've explained control risk, and I've explained detection risk.
Sorry, sir.
Yes.
You said, I want to get the definition you gave for this detection risk. You said it's
Yes.
a risk that the auditor procedure
Other procedures and testing. We
and
fail,
testing.
the auditor's procedures and testing, we fail
If
to achieve the audit objective. Is that clear?
the audit objective,
Yes.
that's
That's
okay.
detection risk.
Okay, sir. Thank you.
All right. So of these three components of audit risk, only one is within the control of the auditor. And the other is within the control of the auditor is detection risk. Inherent risk and control risk is outside the control of the auditor. Only the detection risk the auditor can control. Okay. So what that implies is, sorry, what that implies is the other two, he doesn't have control over them. But the detection risk can control. What that means is that if he updates his knowledge, if he has the right training, okay, if he has the right understanding, the detection risk will be what? Will be minimal. That means all the tests that is going to perform, all the people is going to perform, will achieve the needed objective. Okay. But the inherent risk and control is these two are outside his control. What that implies is that, and those two, they are always going together. That is when the inherent risk is high, the control risk is also very high. When the inherent risk is high, the control risk is also what? High. So when the inherent risk and control risk are high, detection risk will always be on the low. I take it again. When the inherent risk and control risks are high, detection risks are always what? On the low. It's always low. So because of that, that gave rise to what we call the audit risk model. That gave rise to what we call what? The audit risk model. The audit risk model is a model that helps the auditor to identify and quantify the what, or that helps the auditor to what? To reduce the audit risk to an acceptably low level. It shows the relationship between the inherent risk, control risk, and detection risk. So the audit risk model is a model that shows what? The relationship between the what? Inherent risk, control risk, and detection risk. And it also explains the need why the audit risk should always be at what? At the acceptably low level. That means at all times you cannot eliminate audit risk. You can reduce it to what? To the lowest acceptably level. You can't eliminate it. In your CSME, you say that risk cannot be eliminated. It can only be what? Be managed. You can only reduce it to what? To the lowest level. Okay? I hope that is clear. All right. So let's go to the next one. Fraud and error. Now, what's the difference between fraud and error? The difference between fraud and error is the intention behind the act. The intention behind the act. Okay? Error, both fraud and error, they are not permissible. They are not they are not to be promoted or to be allowed or tolerated. Both of them, they shouldn't be allowed or tolerated. Okay? So fraud is what? Fraud is an intentional act which may involve what? Fraudulent transaction, fraudulent financial reporting, such as falsification of records or documents, or a deliberately incorrect application of accounting policies, misappropriation of assets. That's what we mean by what? Fraud. That is when there is an intentional act that aim at what? Fraudulent financial reporting, misappropriation of assets. While error is defined as an unintentional misapplication of accounting policies, oversight, unintentional clerical mistakes, and or unintentional misinterpretation of facts. Okay, that's what we mean by that. All right. So another area you need to look at, your fraud and error is covered under ISA 240. Okay, and ISA 240 identify the two types of what? Fraud. And we have the fraudulent financial reporting and misappropriation of assets. The type of fraud that you have as regards ISA 240 is fraudulent financial reporting. Number two is what? Misappropriation of assets. So what are the examples of fraudulent financial reporting? Fraudulent financial reporting includes forging or altering accounting records or supporting documentation which form the basis for the financial statement. So when somebody forges the financial statement or information in the financial invoices, purchase invoices, sales orders, That is fraudulent financial reporting, or misrepresenting or intentionally omitting events or transactions from the financial statement. So when the management deliberately decide not to post some transactions because they want to understate their revenue or they want to understate their profit, okay, intentional misapplying accounting principles when the accounting principles are wrongly applied, okay. For instance, you know that all assets have what? Debit balances. But when you prepare a financial statement, your asset is having a credit balance. All expenses you have what? Debit balance. Because according to the golden rule of accounting, for every debit entry, there is a what corresponding credit entry. We now discover that your financial statement, when you're checking your expenses, they are on the credit side. Okay. So most times, fraudulent financial reporting involves management override of control. What do you mean by management override of control? That is the management, because of the power they have, they abuse the power to achieve their own selfish interest. Okay, some of the things that they do, examples, embezzling receipts, for instance, diverting them to personal bank account. So they buy some stuff, okay, either for the thing to be for the company, they post it or send it to their own personal account. They might ask them to buy a car for some staff. They will buy the car. And rather than bring the car to the office, they will send it to the work. They will send it to their personal houses. Okay, stealing physical assets such as inventory or intellectual property. For instance, selling trade secrets to a competitor. Imagine you have Coca-Cola and Pepsi, and other uh, related Coke products. You know that if you taste Pepsi, if you have tasted Big Cola, you have tasted Big Cola, you see that they are not the same, they don't have the same taste as Coca-Cola. Coca-Cola has what? A trade secret. That trade secret, if Pepsi should know about it, they can buy it for any amount. So if we have somebody that is giving that information to Pepsi, for instance, that could be seen as what? Fraudulent financial reporting. Or using an entity's asset for personal use. They gave you a car as official, but you're using it for Uber. That is abuse. Okay. Then we go to then ISA requires the auditor to perform the following procedures to identify the risk of material misstatement due to fraud. So what that means is that according to ISA 240, there are audit procedures that you need to follow. So in exam, when they are talking about audit procedure, it means that you must go step by step. What's the trick to answer this question in exam? Because it's very, very common. It's a common examinable requirement. When you see questions that talk about audit procedure, if you don't know all the procedures, at least know the first 5 or the first 6. Because audit is what is prescriptive. Once you miss any step, I'm telling you, the examiner is going to penalize you. Because that means that you'll not be able to achieve the audit objective. So that's why they call it procedure. Audit is what is prescriptive in nature. That is, you go step by step. If you jump any step, you will not achieve the result. It's just like science. You want to perform a test on starch or protein now. If you don't go by the procedure, you'll not be able to achieve that result. So this procedure are things you need to learn by heart. Okay. Number one, when the auditor wants to perform procedure to be able to detect if there is a material misstatement due to fraud, the first thing we need to do is to make inquiries of management in respect of the assessment of the risk of material fraud. The process in place for identifying and responding to the risk of fraud. Okay, all this one is still under one. Just know the first one. Make inquiries of management in respect of their aspects of the risk of material fraud. The process in place for identifying and responding to the risk of fraud. Any specific risk of fraud identified or likely to exist. Any communication within the entity in respect of fraud, including any communication within the entity in respect of fraud. including the employees regarding management views on business practices and ethical behavior. Number two, make inquiries of management and others within the entity as to whether they have any knowledge of any actual suspected or alleged fraud and to obtain views about the risk of fraud. Number three, evaluate any unusual or unexpected relationship identified in performing analytical procedures covered in later chapter. We're going to look at that in later chapter 6, the next chapter, okay? Which might indicate a risk of what? Material fraud. Evaluate information obtained from other risk assessment procedure to see if any fraud risk factor is present. Okay? So what they are saying, like I said, these are procedures, okay, that you need to know. In case you cannot remember everything, ensure you know the first few ones so that you will not miss out completely. Once you misplace it, and in an exam, I'm telling you, the examiner is going to penalize you. Another reason that somebody will finish exam and say that, oh, I did not pass audit. You see your score and I say, I got 48, I got 49, I got 5. These are the reasons because the procedures have not been followed. Okay? So fraud risk factors. We talk about fraud risk factor here. This is it here. This is bolding. For this factor, okay, include the following. You need to meet the expectation of a third party. For example, the entity is trying to obtain additional finance. So for this factor, somebody wants to obtain finance from the bank now. They now decide to go and jack up their revenue. That they make so much money, that they don't make so much money. Okay, management being remunerated via profit-related bonuses. That they tell the owners of the company and said that the more profit you make, the more the bonus. So the management will do all it takes to make more money so that their bonus will also increase. So they can involve in any dubious business just to increase their what? The profit so that their bonus can also be increased. Another one, an ineffective control environment. So that is called, what that means is that they don't have a good structure in place. There is no good internal control system. Everything goes. Where everything goes, I mean, they can do any kind of business. There's no control. There's nothing in place. So that can also be a fraud risk factor. All right. Other examples of fraud risk factor is the entity's profitability being under threat. For example, due to increased competition or rapid change in technology. For instance, like what we have now, we are seeing let's say you have a competitor like Coca-Cola and Pepsi that I just talked about. If they change their label or they change something about their product and there is a threat to the existence of Coca-Cola, Coca-Cola can do anything possible just to ensure that they keep their market share, whether ethically or unethically. That's just for knowledge, okay? Another example of fraud risk factor, the nature of the industry or the entity's operations providing opportunities for fraud. For example, complex transaction or significant accounting estimates. So there are certain transactions that they do. For instance, they give outrageous estimates. Okay, they give bogus estimates, something that is beyond, that cannot be realized, that's not realistic, just to show that they are doing that much because they just want to prove a point, and that could lead to what we call the fraud risk factor. Okay, personal pressure, I mean low morale among staff or poor communication and or enforcement of ethical standard by management. So when there is no structure, people that override controls, existing controls, they are not penalized, they are not abused. They are not abused. Okay? They are not penalized, they are not abused. So what that means is that it's a free for all, it's free for all. Everybody can go and do whatever they like. Okay? That's what we mean by that. Then we have personal pressure on staff to misappropriate assets. For example, personal financial problems or the threat to redundancy. So for instance, when a staff has been told or he senses that he might soon be laid off, Okay, he says that he might soon be laid off, but he says that if he works there for 10 years, there's no gratuity. Some staff can be so disgruntled to the fact that when they're about to leave, they can decide to damage whatever asset that is in their possession. For instance, let's say you have a driver that has worked for an organization for 10 years. I'm just saying now, allegedly, right? And he knows that if he starts the organization for 10 years, they're not going to give him anything as bonus or gratuity. Can decide to do something to the car, and the company will spend so much money to fixing the car. And he will be the one that's going to recommend the mechanic, or sometimes he has partnered with the mechanic to be sure that he gets some rebate from the repairs they do on the car. That is fraudulent, okay? Then we have opportunity to misappropriate assets. For instance, large amounts of cash held or possessed or highly portable or valuable inventory. So, for instance, you have some sales rep that will make a way, or they made a way with companies' goods or inventory. So they go and sell it and realize the money, collect the money without depositing the money in the company's account. Okay. Another example of fraud factor is poor internal control over assets. What that means is that when there is no segregation of duty, one person is the one approving, the same person is the one posting, the same person is the one going to bank to withdraw the money, the same person is the one retiring IOU, doing everything, raising journals, preparing financial, one person doing everything. That will give rise to what? To fraud risk factor. All of these are what the auditor need to put in place to ensure that he puts controls in place to mitigate all of this. You cannot eliminate fraud in an organization, but you can reduce it to what? To the BRX minimum. Okay? Then that takes us to the last aspect of this chapter, which is auditing for not for profit organization. What that means is this. All what we have been discussing so far is about profit-oriented organization, business that are out to make profit. We have some companies or business that are not out to make profit, to render services to the people or to improve the lives of the people. We call those kind of businesses not for profit making organization or charitable organization. Okay. Now, what that means is that if you are going to carry out an audit of this company that are charitable organizations, they follow the same pattern as when you go for the audit of the profit-making organization. Okay, even though the objective of the audit is not to show how the company has made profit, but at the end of the day, the objective will differ in the sense that this will be talking about accountability, how the money that the company have generated in the year under review has been properly accounted for. It's not about profit this time around, right? So the approach they are going to take is that the auditor will also carry out his audit plan, develop his audit plan. In his audit plan, he will develop the objective and scope of the audit. He will ensure that he complies with any local regulations that apply. We also ensure that the environment in which the organization operates, that he has a proper understanding of the environment, that he understands the laws, so that they're able to enjoy some maybe advice on tax rebate, okay, or tax holidays, okay, all of those things, or pioneer legislation, all those things in taxation. Then, still on planning, the form and content of the final financial statement and the audit opinion. That is, when he's doing his plan, he needs to be able to conceptualize what kind of opinion can he give at the end of the engagement before he set out. Okay? Then key audit areas, including risk. That is, when he's going to audit the charitable organization, he should know that which area is going to focus on. For instance, he might focus on the receipt, cash receipt, the bank statement, they focus on that area to see whether all the money that they have collected, they have banked all the monies. Okay. Then the second aspect is going to look at is the risk. You must carry out a proper risk analysis, or we call it preliminary audit risk assessment as well, where is able to identify the inherent risk. Charitable organizations, they have inherent risk that's peculiar to them. Most importantly, is the nature of the entity. When you have a charitable organization, most times they don't have structure, they don't have internal control in place. So the owner of the business is the one in charge of everything. There's no delegation of duty. So there's always abuse of power. Okay? Then you have what we call control. They don't have any control. Even if they have internal control, the internal control they put in place are always overriding. They override the internal control. And the detection risk, okay? The auditor will also fail to obtain to be able to achieve his audit objective. Why? Because the audit evidence he wants to obtain, right, is not available. Because when you have most of those charity organizations, they don't keep proper books of record. Don't keep proper books of record. So that can lead to detection risk. Then internal control. Internal control is always also poor. We will look at it, but most times it's always poor. Okay, we look at whether there is segregation of duty, whether there is proper authorization of spending, whether they have control over cash. Okay, authorization of spending means that before they spend any money, does it go through the right approval? Do they have a board or a committee that approves before the money is being spent? Cash control means that for every money that they spend, they have proper record for them. Okay, there are certain things that they cannot buy without obtaining approval, and there are some that they can just buy whether they are in need of it. Okay, then you have control over income, that is donation, cash collection, membership fees, and grants. So what that means is that we have grants, we have donation. Okay, so there should be proper record for all of this. Then the use of fund only for authorized purposes. So for certain organizations that obtain money from donors, the money that they obtain from donors, which they call grants, they are specifically for certain purposes. So if they don't use the money for specific purposes, they will not be qualified to receive future funding from such donors. For instance, Bill and Melinda Gates Foundation, they give money, they give grants, and they tell you that you should use the money for so and so. If the charitable organization does not use the money for what it's supposed to use it for, next time, Bill and Melinda Gates will not provide such grants to such charitable organization. So the auditor will look at all of these things. And audit evidence also, will look at it. So most times, like I said, the charitable organization, they are small, they are seen as small business enterprises. So the audit approach the auditor will use is substantive testing audit approach because they don't have any structure in place. The auditor will look at everything. They don't have documentation. The auditor will look at everything. The auditor will also look at key areas. You look at record keeping. You will look at misuse of fund. If there's any possibility of misuse of fund, it's going to carry out analytical procedures if it's possible to make sense of the figures that have been reported. For instance, it might look at how much they say they deposited over the years or over the months under review. All right. Then there should be a review of the final financial statement, including a review of the appropriateness of the accounting policies. So we also will look at all of this is still part of audit evidence. Then when it's done, just like any other audit engagement, it's going to write its report. And the report will also state whether the financial statement shows a true and fair view, okay, or it complies with all the laws and regulations that is supposed to have been complied with while preparing the financial statement. Okay. Then it will also contain all the other segments of the report, such as the scope of the report, responsibilities of auditors versus the responsibilities of the management. Okay, responsibilities of management, the audit work done, the audit opinion, the date, name, and address of the auditor will also be contained therein. All right. So just like I said, it follows the same process, okay, as though you are doing the audit of a company that is out to make profit. The only difference is that the objective would differ, okay, because you want to show that there is proper accountability for all the money that has been donated or granted to such charitable organization. Does anybody have any question on this? Any question, any comment, any observation on this audit approach for audit of not for profit making organization? Any question? Any comment? Any observation? Are we together? Please respond, though, please. You're almost done. Okay, that's fine. Okay, thank you. So we go to the last part, which is the public sector audit. Public sector audit. You know that what are public sector? These are the ministries, government ministries, departments, and agencies. Example of ministry, Ministry of Power and Steel, right? Department, we have Department of Petroleum Resources, okay? Then you have the agencies. Example of agency is NAFDAC. These are agencies. So all of this, they also undergo audit, right? And the law specify that all these MDAs, ministry, departments, and agencies will be what should be audited from time to time to be sure that there is proper accountability for all the money being allocated to them. So what that implies is that according to ISA, right, some countries they have established what we call a quasi-autonomous non-governmental organizations, QUANGOs. This is it here. They've established what we call what? Quasi-autonomous non-governmental organizations. Okay? So what do they do? Let me explain what they do. Now, in Nigeria, we have something like that. Some of us have heard of what we call budget. There's a body or there's an organization that is called budget. BUDGIT, budget. What do they do? So once the Corporation Act has been passed into law to now become the budget for the following year, this organization will analyze all the budgets to explain to the public if the budget is going to have an impact on the public or not. If the budget is really meant to improve the lives of Nigerians or not. If the budget has accommodated or has accounted for proper education or literacy for Nigeria. So this organization is what they do every year. Okay, ICANN also does it. They have a symposium anytime the budget is passed to try to, they will bring in dignitaries, they will bring in their members to come and dissect what is in it for Nigerians in that budget. Now, what they are trying to do is this. They are trying to ensure that the money that they have allocated, first of all, is that money reasonable or the money is just over bloated? Some instances, that is where they discover there's padding. They've padded the budget. It's the area they always get it. They talk about subsidy removal. These are the area they are going to see. Okay, this money that they have put, how are they going to spend it? Even when the budget has been passed, even at the end of the year, they can still do the audit and say that this money has not been spent because every month the government roll out the FAC, the Federal Allocated Federal Account Allocation Committee, something like that, FAC, that shows how the federal government has disbursed money to the federal, to the state, and the local government. So they see how the money is being sent, is being distributed along the various levels of government. So when they see that this money is not utilized, is not put to good use, they can still come out and attack the government. This protest that they are talking about, you go and check, is the fallout of some of these agencies that have been able to put some indicators out that this government is not maybe protecting, is not how to protect the civilians or the the majorities. That's what they clamor. That's the clamor for this protest. That's why you have this protest on. So what they do is just to, aside from the fact that they are set up because they are not, if you look at the name, they call them quasi-autonomous non-governmental organizations. They are not operated by government. It's not the Accountant General of the Federation or the state office of the Accountant General of the state. No, they are non-governmental. Because if they are governmental, their independence and objectivity will always be in doubt. So that's why they always make use of what? Non-governmental organization. These people, they believe that they are objective, they are independent, and they can give uh, factual information about how the ministries have performed. If you look closely now, that some people, there's information out there that some of the ministries, they are not performing. So if the government is attentive or is responsive to the information, it should be thinking of how to change some of the cabinet members, the ministers, in the next few days or few months because they are not performing. The information is out there. It's these organizations that put this information out. And those are the things that they put together and they call it what protest what against what bad governance. So this non-governmental organization, this quasi-autonomous non-governmental organization, they are out to serve as watchdog to be sure that there is proper accountability for public fund. Okay, so that's what they do. So at this point, we come to the end of the class. Does anybody have any question? So that is all for chapter 5. Does anybody have any question? Any comment? Any observation? Any comment, any observation? Okay. The
Hello,
last question yes. I'm with you,
okay,
sir. Mr.
yeah, my observation is, I don't know, in the course of this whole study, if we can as well try to, I know the time is not really on our side, can as well maybe take note of past questions that deal directly with this topic that we are doing. And it
No,
will
I
help us
sent questions. Yes, I sent the last topic I took. I sent questions to you, to the group. Nobody has responded. Maybe one person has responded. So if you don't respond, you don't motivate me to continue to send questions. But however, I will keep sending questions. But I will always employ us to make an attempt because you never can tell to what extent these questions will go to assisting you. Because the essence of these questions I'm sending, and the first one I sent to you, you responded. The response was very positive, and I was able to give out the answer. But this second one, when I took the last chapter, no, maybe one person responded, and that was not good enough. However, I will still send questions on this chapter, provided you respond. But if you don't respond, I'm not going to send the answer.
by
So
response, you
please,
mean that dropping the
you said,
answer.
you said?
By response, you mean dropping the answers in the group. Is that what you're saying?
Yes, it's your response that will push me to drop the answer. So if you don't respond, it shows that okay, you understood everything. There's no need for me to put the question and the answer because you have not responded to the question. But however, I'll still send the question for this chapter, like I always do. Please respond. It's an attempt. I'm not going to mark it. I'm not going to say that you have done bad, you have done well. It's just for you to know where you are not getting it right. That is the essence of this class. If you know it very well, if you can do it on your own, there will not be this class. But to encourage you and to put you on the right track for the examination, that is why you are here. Some of us have read this material over and over. If I call some people here, they will tell you, I can read this, I can have read it from back to back 7 times, 10 times. But ask them when they see questions, they cannot attempt it because the comprehension is different from how to answer questions. When you don't avail yourself to answering those questions, then that means the aim is already defeated. Mr. Oluwaseun, you raise your hand. Any question?
Yes, please. So I want to clarify a point you made earlier. You said that
Yes.
when the inherent risk is high and control risk is high, that the audit something will be low.
Detection risk.
Okay,
Okay, what I
detection
said
risk
is
will be
this.
low.
Yes, this is it.
Yes.
The whole essence of audit risk. Thank you for that question. The whole essence of audit risk is this. The essence of audit risk is to ensure that it is brought to what? An acceptably low level. It should always be on the low. You cannot eradicate, you cannot eliminate it. We can always reduce it to the barest minimum. Now, for you to reduce the barest minimum, there are three components you need to factor. What does that mean? That is, if the inherent risk and the control risk, they're always going on the same direction. What does that mean? That is, if the inherent risk is high, control risk will be high. If inherent risk is low, control risk will be low. They go together. They're like 5 and 6. However, when inherent risk and control risk is high, detection risk will always be on the low. When the inherent risk and control risk is high, detection risk will always be on the low. And when inherent risk and control risk is low, detection risk will be what? Will be high. When the inherent and control risk is low, inherent risk will be what? Will be high. So that is the audit risk model. The whole essence is to ensure that the audit risk is brought to a what? To an acceptably low level. I hope I'm able to answer your question, Mr. Oluwaseun.
Please just permit me. I just want to just understand this thing better. So what I'm thinking in my head, based on the definition that you gave us for those risks. So what you're saying now is that when inherent risk is high, that means, and the other one,
Okay, let me explain. Let me explain. I understand what you are saying. Now, okay, let me give an instance. Let me give an instance. Now, when you talk about inherent risk is high, what that means is that when you say inherent risk is high, that means that all those account balances that are susceptible to manipulation, they've been able to take care of them. They are not susceptible to manipulation any longer. That's what it means. The auditor has been able to check that all those instances that can lead to manipulation of those account balances and account transactions, okay, the auditor has been able to check it and see that, oh, all necessary mitigation or mitigants or control have been put in place. So that thing it will not happen. Okay. Then we talk about control is also is the same thing. That is, the control is also on the high side. That is, they have been able to is on the positive. When you talk about positive here, it means that the control is always what is on the positive. The inherent is always on the positive. Then when you talk about detection, is what that means is that if the or when the inherent risk, the account balances, they are everything is showing as it's supposed to show in line with the standard, right? That means the risk that the auditor will the procedures will fail to achieve the audit objective will be what? Will be very low. The risk that the audit procedures and testing will fail to achieve the audit objective will be what? Very low, because the control risk is high, the inherent risk is also high. These are positive. So when they say control risk is low and inherent risk is low, that means that the inherent risk, the auditor, the inherent risk, the auditor has not been able to find a way around trying to check whether those internal control systems are working as intended or not. It does not know. So if it does not know, that means that his detection risk will be very high in that regard. That is, if there's every chance that he will carry out, he will conduct some audit tests and procedures, and the result will be what? Will be low. Do you understand what I'm saying now? Mr.
Yes,
Oluwaseun?
I understand now. Thank you, sir.
All right. Any other question? Are we good? Thank you very much. In the absence of any other question, so I'll be sending your questions to you, if not today, if not tonight, tomorrow morning, by the grace of God, I'll send it to you. Please endeavor to attempt. Okay? Please endeavor to attempt. It's for our own good. For you to pass ICANN examination, right? You must practice as many questions as possible. If you don't practice questions, you will not be able to know how to go about answering questions in examination. You wouldn't know. Please Make it a culture. The second one, the last one I sent, please respond to it and send your answers. And also this one I'm going to send tomorrow. Please respond and send your answers so that you will encourage me. Okay? Doing this one I'm doing, explaining this thing is one aspect, right? Be able to tackle questions in the exam, which is the ultimate, is another aspect, it's a different aspect entirely. And that is the essence why this class is held. Please, let's work together so that we can achieve this success. I've told the people that it's not today I've started, I've been doing this over the years, and it has always worked. There's a trick for you to answer an kind of examination. And if you don't practice the question, you cannot understand the trick and the logic. Please make it a point of duty to always do that. Thank you very much for your time. For those that are able to wait, thank you. I do appreciate. I'm not taking you for granted. You tried. For all the questions that have been asked, for all the observations, I do appreciate. So hope to see you next Friday, God's willing, right? Where we'll be talking about audit evidence and sampling. Like I did this time around, I'm also going to send your material earlier so that you can read it ahead of the class. And that will afford you the opportunity to be able to ask questions as much as possible. All right. So if there's no question, if there's no comment, if there's no observation, I request or I plead that the class is adjourned till next Friday, God's willing, when we shall meet again. Have a lovely evening and thank you for your time. Have a good night, rest.
Thank
Thank
you,
you, sir.
sir. Good night.
Night.
Thank you.
Night.